Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra, and today we are talking about the Metaverse, which is one of the hottest tech buzzwords lately. And investors have now realized that it's not just a buzzword, particularly when CEOs of some of the most valuable companies in the world started talking about it as being the next generation of the internet or successor to the mobile internet. Facebook CEO Mark Zuckerberg expects Facebook to be seen primarily as a metaverse company and not as a social media company in the coming years. And NVIDIA CEO Jensen Huang said that Metaverse is where we will create the future, and Metaverse is going to transform how the world's biggest industries operate. Microsoft announced on its earnings call that it is developing an enterprise metaverse, and Apple is also investing in it. So this is a space investors should keep an eye on because this is likely to become a significant investment opportunity in the coming years. My guest today is venture capitalist Matthew Paul. He's a very well-known expert on the Metaverse and the index partner for the Roundhill Paul Metaverse ETF, ticker symbol Meta. Matthew, welcome. Great to have you on the show.
Thank you for having me.
So to start off, tell us a little bit about your background and what got you interested in this futuristic digital world.
Sure, that's a great place to start. I've dedicated my career as a strategist, an investor, and an operator to what I consider to be the next great change for consumers in particular, but also the hardest problems facing businesses tomorrow. That started in the late 2000s, focusing on smartphones, on the digital app economy, helping large companies, predominantly in the TMT space, but a little bit beyond that, shift towards digitally and mobile delivered services, apps that meant building technology, applications, back-end stacks, things like content delivery systems, dynamic ad insertion systems, and so forth. Subsequent to that, I went to the Chernin Group where we built, bought, scaled, and developed digital communities. That was the next big problem that I saw, which was how do you use the internet as an opportunity, not just for social networking, but to build new brands, new communities, new platforms. Subsequent to that, I went to Amazon, where I was the first head of strategy for Prime Video at the point in time in which the streaming wars were starting. How do you build the largest video business in history? And from that, I moved to gaming, the next forefront, and now the metaverse, the next hard problem. And so I pursued my passions, what I thought was interesting to me, but in particular where things weren't certain. And certainly, when one's talking about the metaverse, very little is clear at the moment beyond the economic opportunity and some of the likely winners.
Right. So you have written extensively about the metaverse, and I certainly encourage our listeners to visit your website if they are interested in the metaverse. And one of the essays which I found very interesting, it is the metaverse, what it is, where to find it, and who will build it. So take it away.
I think one of the best ways to think about the metaverse really is the framing as a successor state to today's mobile internet. Much like today's mobile internet built upon the internet, but changed some of the devices we used, the technologies that supported them, also led to new emerging business models as well as consumer behaviors. The metaverse will do the same. In this case, the transition is not so much about moving where we access the internet, i.e. from a desktop computer in our homes to a supercomputer in our pockets, nor how frequently we access the internet, i.e. from time to time in our homes to constantly in our pocket, but instead shifting more of our time, spend, leisure, labor, existence, socializing, and some of our wealth into virtual environments and simulations. We can coin that as the metaverse. There are slightly different perspectives on what the metaverse means, But what matters is that it is building upon everything that we have invested in for decades, from mainframes to broadband infrastructure, to our mobile devices, to our digital first economy, into something that feels distinctive and new, yet also reaches everything in the world.
Excellent. There are many words which are used in relation to the metaverse, virtual platforms. You mentioned digital communities, NFTs. So could you talk about some of the terms that investors who are interested in this space should be aware of?
Sure. A great place to start is XR, VR, and AR. They are often erroneously conflated with the metaverse. It's a bit like saying that the mobile internet is a smartphone. A smartphone is the primary device through which the mobile internet is accessed. It often governs the business models and the practices of the mobile internet. But of course, the mobile internet is a vast, wide-reaching network of infrastructure, of compute devices, and its range goes far beyond that, right? We would not say that the way in which a hospital or a plant has been transformed through the internet is a reflection of the device that's being held by an individual. And so it's important to recognize that, like the internet, like the mobile internet, we're talking about underlying technological change that sometimes changes access devices, but goes much farther than that. It's also important to recognize that XR devices are a helpful way to see the change, right? Much like an iPhone is an easier way to compare to the 90s internet, but it's likely to be a smaller part of the metaverse. We think the total number of XR devices will be between 200 and 400 million by 2030. Unity's CEO has put a forecast that high. Some of the early expectations of Facebook, Snapchat, and Apple seem to show that far. But of course, there's 5.5 billion active smartphones in operation today. There's billions of PCs, billions of other devices that connect to the internet. XR will be an important device. It's not going to be the primary device. What is more important is to take a look at buzzwords like game engines. What's important about game engines is to understand that for decades, the most sophisticated digital experiences of scale have been games, because they have to, in real time, render dynamic environments with a wide range of predictable but non-deterministic outcomes, right? They're adhering to physics, but they don't know exactly what you're going to do. And so game engines for decades have had to manage for many different events, all of which have to adhere to clear and provable rules, right? We know what a car shouldn't do, that support all of the technologies that we touch in a diverse number of applications, all in real time. We can't wait for 5 minutes to process what our car should do. And so as the world has shifted towards more simulation technologies, as we start to simulate the worlds around us, game engines have become the best tools. And actually, many of the non-game engine tools, such as those used to render a car for design or design a building from an architectural perspective, have determined that they're not suitable for simulation because they never prioritized it. And so game engines, Unreal and Unity, have become focal to that. The last key buzzword is to take a look at new standards and protocols. The web today, the mobile web, the app economy, flourishes because of commonalities of technologies as well as systems that run everywhere. As we change to the metaverse, to virtual environments, we need new standards and protocols that will operate and stitch together, ensure consistency across these simulations. And so we have companies like NVIDIA releasing their Omniverse platform, a system that brings together disparate file formats, technologies, and even game engines. We have the determination of new standards, such as those in XR, digital identity, to some extent cryptocurrency, all designed to support this next phase of the internet.
That's very helpful. Now, let's talk about why investors should look at this space. What kind of market opportunity is there, and it's going to be created in the coming years from the metaverse? Is it going to be in billions of dollars or trillions of dollars? And are these economic opportunities going to arise mainly from advertising or sale of merchandise, digital merchandise, or something else?
That's a great question. My belief, and the one that seems to be shared by the likes of Mark Zuckerberg, Satya Nadella, Tim Sweeney of Epic Games, is that we are talking about a decade plus transformation that will create, destroy, or reshape trillions of dollars of value. The most valuable companies today, our trillion-dollar market cap leaders, come from either the internet era or the mobile internet era. We saw which of the largest retailers in the world change as a result of those transformations. And we're seeing new contention again in the mobile era. You can take a look at Shopify versus Amazon, Amazon being a beneficiary of the 90s and 2000s internet and succeeds today. And so the baseline expectation is trillions of dollars commensurate with the internet transformation and the mobile internet transformation. Not only is it extraordinary in size, not only will it change the pecking order, but it will reach almost every category and every market in time. We can already see some of those early examples. Take a look at the 90s and the early 2000s. Telecommunications and payment rails and systems were disrupted by companies such as Skype, as well as payment processors and digital payment networks like PayPal. When you get to the mobile internet era, we saw additional companies emerge in that use case. We see Square, Stripe, Shopify, I mentioned earlier, Venmo in the payments category. Skype has been largely succeeded by WhatsApp, much larger, and in the case of Snapchat, different companies that advance internet-enabled communication to a new internet platform, the mobile internet. And now, when we take a look at the early transference to the metaverse, we see those categories disrupted again. Discord, a $10 billion plus company designed for this use case. Cryptocurrencies are disrupting today's payment rails. We have Coinbase, a $60 billion company, FTX, the fastest payments-related company to a $10 billion valuation ever, that is now valued at 20 billion plus. In time, we expect most categories to be disrupted. For any investor, that makes the metaverse as a theme critical. We all wish we could have gone to or go back to 1995 and buy Apple stock, but some of us instead bet on Nokia or Samsung. And at the end of the day, had you invested in the theme, the internet, the mobile internet, social networking, digital communities, direct to consumer, least of all a basket of those many things, your returns, because of the size of the change, the size of the economics, would have been extraordinary. That is essentially the theme that's behind the ETF.
Correct. So let's talk about the ETF and the index behind it. It is the Ball Metaverse Index. And this is the only ETF currently which offers investors exposure to the metaverse. So tell us how constituents are selected and weighted in this index.
If you believe, as I do, that the metaverse is a wide-ranging transformation that is not just about any specific game engine or virtual platform, but instead the global economy, you believe that it requires many different things and changes. And so to start there, I assembled an expert council of 6 other individuals. Those individuals come from enterprise cloud technology, game streaming. They built many of the biggest games in the world, such as the lead game designer and executive producer of Grand Theft Auto. They worked at Oculus and Valve in VR. They come from the cryptocurrency and venture investing world from Andreessen Horowitz. They extend into media such as the New York Times, as well as securities. The scale of this transformation requires diverse perspective and expertise. And so I started with the council. This council then determined 7 broad categories that are all going to benefit from and are required for the advancement of the metaverse. We've defined those 7 categories as hardware, compute, networking, interchange standards, protocols, and services, which you and I just discussed, the virtual platforms, i.e. the worlds that many of us will interact with, such as a Roblox or a Minecraft, payment services, and then the content services, identity economy, i.e. the things we consume and buy. We then took a look at these 7 categories and mapped their expected share of profits and revenues over the next 5 years. For that, we took a look at traditional allocations through the emergence of the internet and the mobile internet, as well as their trends today. That's critical. If you take a look at the internet, the first decade, the vast majority of revenues were collected by device manufacturers, your Dell, your Hewlett-Packard, as well as networking companies that provided broadband equipment, modems, routers, as well as the telecommunications providers, your Xfinity, your AT&T, your AOL. Over time, the content side of the internet grew. We did not have Spotify, Netflix, Tinder, Fortnite in the early internet, but eventually their share of revenues grew. And so we have a methodology that maps the metaverse technology and revenue and profit pool, uses precedent plus the changes, because of course we don't exactly repeat that history. And that provides us with categories and weightings. We apply those categories and their attendant weightings to the entire universe of public companies on the majority of public stock exchanges globally. We then remove a handful of companies based on average daily trading volume or market cap, just to manage for stability and liquidity. But then we rank all of those companies on 4 tiers. Pure play, which means that these companies are effectively growing based on the emergence of the metaverse. Core, which is to say these companies are substantially focused on the metaverse or benefit from. Non-core, which is to say their business is not driven by, but does benefit from. And then not applicable. So for example, a company like Nike does not have a game engine. And so you can imagine that in that category, they would not qualify. Those have different weightings, pure play, core, and non-core. That produces our index. And we have individual rules for how you would categorize pure play versus core, which depends on share of revenues, the number of protocols or developers or users, and produces a passive thematic methodology. With the Meta ETF, we are not actively trading. We are not saying we believe that this company is more important than others do. We don't say it's undervalued. We don't say that this is an opportunistic opportunity to get our average cost down. Instead, we say that we have a vision of the future that's informed by rich expertise and historical precedent. We have a methodology that we believe will therefore track the emergence of the metaverse. And therefore, if you believe in that methodology, if you believe in the economic value of the metaverse, should produce returns as the metaverse grows.
Very interesting approach. Now I'm looking at the top holdings: NVIDIA, Tencent, Microsoft, Roblox, Unity Software, Autodesk, and TSM. These are among the top holdings in this index. Could you talk to us about some of the top holdings that you like a lot, how they are related to the metaverse, or how they are contributing to the advancement of the metaverse, or benefiting from that advancement?
NVIDIA is one of our top holdings. In fact, it's most highly weighted today. And NVIDIA is a brilliant company. It's one whose market cap has grown tremendously over the past 18 months in a way that surprised many who look at it as just a chip designer, a compute provider. It's now more than $500 billion, more than twice the size of Netflix, a company considered FANG, right? And yet NVIDIA is astounding because it reaches many different areas that are critical for the metaverse. At a baseline level, they provide the most sophisticated GPUs, or graphical processing units, required for real-time rendering of complex virtual environments. To the extent in which the metaverse is reliant upon, grows through, or primarily monetized through those environments, there is no company that produces and better powers those experiences than NVIDIA. NVIDIA also has a platform for simulation collaboration that interconnects different providers. They also have leading AI systems for that. And then lastly, their significance in that ecosystems means that they have extraordinary influence over the standards and protocols and technologies that are selected. We have other companies in there, such as Unity, the most widely deployed simulation engine in the world, a company like Tencent, which has more assets, control, publishing rights, content, identity systems than any other company in the world. The ability to interconnect these systems under Tencent is extraordinary. There's obviously regulatory challenges in that environment, which our methodology accounts for. But today, there is no company that can more easily build an interconnected series of virtual worlds with a fully fledged economy than Tencent.
Very interesting. Now, I wanted to talk a little bit about Facebook too, which is included in the index, but it is not one of the top holdings. So during the recent earnings conference call, Mark Zuckerberg said the word metaverse more than 20 times. And Facebook is a very successful social media company. It has more than 2.9 billion daily global users. If you look at the stock is up more than 850% since its IPO in 2012. So it's basically a money-making machine, very successful at that. So why does Facebook want to become a metaverse company instead of a social media company? What does that mean?
I think we can break this down into three different questions. Number one is every time we have a major platform shift, we see new companies rise and other companies often fall or are succeeded. IBM is more valuable than it has ever been, but its dominance has never matched what it had in the mainframe era. In personal computing, it was led by Microsoft. In mobile computing, it's largely Google and Apple. So at best, there's an opportunity to become the new leader. At worst, you might be supplanted altogether. Number two is we can take a look at the things that Facebook lacks today. Its largest inadequacy compared to the other GAFAM companies, or Google, Amazon, Facebook, Apple, and Microsoft, is they don't have an operating system. One of the reasons why this opportunity is so large for them is they have the opportunity to build a new operating system, the gateway device for this next stage of the internet. And that's an incredible opportunity. Lastly is the economics altogether. If Facebook can go from primarily a leisure platform to one that's involved in creation and labor that powers the economy, there's extraordinary value there. Jensen, the CEO of NVIDIA, has said that he believes the metaverse will exceed, or the economy of the metaverse will exceed the actual physical economy in the years to come.
Excellent. Now, so I understand that this is going to create a lot of value for many companies, but it is also going to require a lot of investment and infrastructure and processing power over the next several years. And major tech giants, they are already investing a lot in this space. So who do you think will win the metaverse? Would there be a dominant metaverse, or we will see multiple metaverses created by these different companies, maybe technology giants, and those metaverses will compete with each other in your view?
The best way to look at this is to take a look at the internet and the mobile internet. There are, of course, billions of different websites, different platforms, different domains, registrars, ecosystems, and communities. And yet the vast majority of engagement, of time, of data, of spending, of traffic is across a few horizontal platforms, your Google network, your Facebook network, to some extent the mobile app operating systems and hardware such as Apple. It's highly likely that for the metaverse, no matter how democratized, decentralized, and open, that a few horizontal platforms dominate in much the same way. Network effects are potent. R&D feedback cycles are potent. Developer economies, which is to say, where you build has an impact on how much you make. And therefore, the economic flywheel of any one platform is going to be an advantage in collecting more, which creates more experiences, which attracts and retains more users, generating more revenue. Given that precedent and that dynamic, plus the fact that we are already going into the metaverse with many strong, powerful, successful companies and competing standards, Unreal and Unity, Facebook and Apple, it's highly likely that we see a similar structure. Otherwise, we would have to so significantly constrain the development of the metaverse by saying it's only going to accept these devices, only going to accept these games and technologies. That's impractical. And more importantly, we're already seeing different experiences start to interconnect in identity, in data, in assets, or in customers. And therefore, we're likely to see an organic evolution like the internet, like the mobile internet, that's messy, but nevertheless consolidates around a few players.
Makes a lot of sense. Now, switching gears a little bit, I wanted to talk about China exposure in your ETF. And this is a global theme. And so you own some of the Chinese companies in this index in the ETF. And in fact, Tencent, the Chinese tech giant, is the second largest holding as of now. And overall, the China exposure is about 10% in the ETF. And we know that Chinese tech companies have been beaten down lately because of the regulatory crackdown. In fact, Tencent is down almost 40% since its peak in February. So are you worried about the China exposure and the regulatory crackdown in the country?
I think it's important to recognize that when you take a look at the major media categories such as film, China is now 1/4 of the marketplace. Lacking significant China exposure would mean lacking anywhere near to proportional economic or population related exposure to the metaverse, much like the internet is far beyond the Western internet, even the European internet. Many of the largest companies on earth, the $500 billion, $600 billion, $300 billion companies, are in China. Many of those are 50 to 300% larger than they were pandemic. And so while they are down substantially over the past 2 quarters, they're substantially far more so up over the last year and certainly over the next 5 years. That exposure is important. At that same time, you're right that the regulatory environment has become a little bit harsher. But it's important to recognize that this is correlated. The reason why the state and the government has taken such a specific view to gaming and interactivity, beyond that they apply to music, beyond that to even printing, is because of the criticality of virtual and interactive and simulation existence to the future of our society. That is reaffirming to the macro thesis of the metaverse, though it does present some local market challenges. Our ETF is based on the emergence of the metaverse, of profiting and correlating from its economic growth. That exposure reflects that. But if and as the environment changes, we have, again, it's a passive thematic index, rules, approaches, and tests designed to assess whether or not the regulatory environment around identity, data, or time produces an impediment that means that the metaverse is constrained financially or on timeline in that market. And so if and as that situation evolves, the ETF, which rebalances on a quarterly basis, will reduce or expand China's exposure based on those rules.
Good stuff. And that's all we have time for today. Matthew, thanks so much for joining us. Really enjoyed the conversation.
My pleasure. Thank you.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. And also make sure to subscribe to our show so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.